Hi everyone, welcome to today's Academy Accounts Workshop. This is part one, focusing on the reporting and accounts format for the 1920 financial year. So really focusing on some of the changes this year, but also some useful reminders in terms of your reporting and accounts. So in terms of today's agenda, after a short introduction, I'll hand to Catherine Biscoe, who will look at the narrative reports in the accounts, and then to Hugh Swainson, who will cover the presentation of the financials, so your financial results for the year. We aim to end with a Q&A session, hopefully closing by about 12 o'clock or just after. So just really before we start, just a bit of housekeeping. So in terms of cameras and microphones, if I could just ask that they're turned off. If you want to ask questions at any point during the webinar, that's absolutely fine. You can use the Q&A chat function. That's available on the right-hand side of your screens, and it looks like two speech bubbles with a question mark inside it. If you type in the question, that's available immediately to us. And if possible, if you could just say who you are in the question, and then we can follow up afterwards if we don't have time to answer your specific question within the webinar itself. But we will try and answer questions where there's time, and as I said, we'll follow up afterwards if we don't have time. And all questions, just to let you know, are kept private. Also, the webinar is being recorded, so it will be available to watch after the event, and we'll also circulate the slides too afterwards, so they are also available. So just moving into the introduction in terms of your reporting framework, and I think really you'll all be aware of this in terms of the structure and the reporting requirements. So in terms of Academy Trusts, as you'll know, you're all companies limited by guarantee, so registered with Companies House, and you're also exempt charities. So really, as a result of that, your annual report and accounts have to comply with numerous reporting requirements. So the Companies Act as a company, the UK accounting standards, which are brought together within Financial Reporting Standard 102, FRS 102. The Charity Statement of Recommended Practice underlies a lot of your requirements, and that's the SORP that brings together the requirements of FRS 102 for charitable entities. And then for academies, in addition, you then have the ESFA's additional reporting requirements. So linking in with some of the more public sector reporting requirements and audit requirements too. So all of this is brought together within the ESFA's annual Academies Accounts Direction. And we'll make sure that Academy Trusts are complying with the accounting standards, company reporting and the charity SORP. And within there, the ESFA helpfully include a set of template or model accounts referred to as the Coketown Academy accounts. So demonstrating a lot of the areas of disclosure, particularly within there that you should follow. So just moving on to the next slide. So in terms of the Academy Accounts Direction itself for this year, it was issued, the 1920 Accounts Direction issued by the ESFA in June, just a few weeks ago. We've included the link there within the slide. So relevant obviously for the accounting periods ending 31st of August this year, and bringing together, as I said, all of those requirements in terms of accounting standards and the charity SORP, together with any additional ESFA requirements. And actually for this year, for those of you who've already looked at this, really just minor updates brought through, particularly in the financial reporting side of it and the presentation of your financial results for the year. But also there are some, particularly in the narrative reports, and Catherine will cover this very shortly, particularly for those of you who are larger, would be classed as large companies, some reporting there that you will need to comply with in this year. In addition, we are also expecting, as with lots of other sectors, COVID-19 has impacted Academy Trusts significantly in terms of their operations. So we are expecting the ESFA to very shortly issue a further bulletin in terms of the impact of COVID-19 on your reporting and also the audit side of things for the 1920 accounts. That has yet to be issued, but we'll cover some of our thoughts today in terms of what we think will be some of the key points and how you should probably address some of the COVID related matters within your 2020 accounts. So I will finish there. I'll now hand over to Catherine, who'll cover the annual reports within the accounts.
Thank you, Kath. Yeah, so I look at the annual report elements within the financial statements. So if I just turn to my first slide, here I've set out what I'll go through in detail. So the Trustees report, the governance statement, the statement on regularity, propriety and compliance, and the statement of trustees' responsibilities. For the first three, I will go through each of these in turn in a bit more detail in the next few slides. But just to pick up on the final point there, the responsibility statement. So this is the board's responsibilities as trustees for the purposes of charity legislation and as directors for the purposes of the Companies Act. And there have been no changes to the underlying legislation, so this section does remain as it was in prior years. So moving on now to my trustees report slide. This is the main part of the annual report. So this sets out really what the Academy Trust is there to deliver and how it's gone about delivering in the year. And I've listed out the main sections. So starting with the reference and administrative information of members, trustees, senior management, professional advisors, and so on. And just a reminder that this section needs to be up to date at the time of signing the report and accounts rather than the year end. You then have the structure, governance and management section. So really this is looking at the governance structure at the Academy Trust. So both in terms of the board, how the board is appointed, how the board is inducted into its responsibilities, but also the delegation of authority to the executive, the senior leadership team, the committee structure and so on. It is also within this section where you have the definitions of key management personnel. So these are those people that are responsible for running, directing, making the decisions of the Academy Trust, and those are deemed to be the trustees and the senior leadership team. And this definition will then link through to the remuneration disclosures that you have in the staff cost note later on. It also includes the trade union facility time disclosures that were introduced in the accounts direction a couple of years ago. And as Kath said, actually a number of the changes to the report this year are actually required as a result of the large company reporting requirements. So these are around employee engagement, business relationships and promoting success, and we'll pick those up in the later slides. You then have the section setting out the objectives and activities of the Academy Trust, and then move on to the strategic report. Really, this is a Companies Act requirement, but as Kath said, within the Academy Trusts, this is embedded within the Trustees Annual Report. It covers the achievements and performance, so really the main section here on the educational outcomes of the Academy in the year. It also includes the trustees going concern assessment. So really here, as you know, you need to be looking ahead a minimum of 12 months from the date of signing the accounts when assessing whether or not you believe your Academy Trust to remain a going concern. The new disclosures around promoting success from the large company reporting requirements I mentioned, they actually sit under the strategic report heading. And then you have the financial review section. So this will look at the Academy Trust's financial performance in the year, its financial position at the year end, how this compares to the reserves it holds and its reserves policy, the section on risk management and uncertainties, and fundraising disclosures if they apply to your Academy Trust. You have then the future plans, and then finally also a large company reporting requirement, the new disclosures on streamlined energy and carbon reporting, and again more detail on that later. So moving on to my next slide, I just wanted to look at some of those new areas that I'd highlighted pink in a bit more detail. So as I said, they are introduced for the first time in the Accounts Direction 1920, but they are actually a statutory requirement of the company's Miscellaneous Reporting Regulations 2018. So if we look at each of them in turn, we first have the requirement for companies with more than 250 employees to include a statement in their trustees report which summarises the action they've taken to introduce, maintain or develop employee engagement. So this will include things such as providing employees with information of matters of concern to them, consulting employees on a regular basis, encouraging their involvement in the company's performance, and also things such as the policy on applications for employment from disabled persons, how a company deals with employees who become disabled, what's their career development opportunities, and so on. And both the Department for Business Energy and Industrial Strategy and the Charity Commission have also published additional guidance on to help companies really think how this might affect them and what disclosures will be needed. The next section arising from these requirements are for large companies to include a statement in their report which summarises how they've had regard to the need to foster the company's business relationships. And this is with suppliers and customers and others. And first of all, really just a reminder on what we mean by large. It is the company, it's at large company thresholds, which are gross annual income of over 36 million, gross total assets in excess of 18 million, and more than 250 employees. And you will qualify as a large company if you meet 2 of these 3 criteria in 2 consecutive years. If that is the case, then these disclosures will apply. And then just the final point on this slide is the third item, which is promoting the success of the company. Again, it only applies to large companies, and here it's a requirement to describe how the directors of the company have acted in the way that's most likely to promote its success. So it will include things like considering the consequences of their decisions into the long term, bearing in mind the interests of the company's employees, the need to foster the company's business relationships, looking at the impact the company might have on the community, the environment, and so on. In my next slide, then we are just looking at the final new requirement that comes from the large company reporting, and this is on streamlined energy and carbon reporting. So as I said, again, only applicable to large companies, and this is the same criteria as on the previous slide, and also only applicable if you consume more than 40,000 kilowatts of energy in the UK in a reporting period. If that is the case, then you need to include some additional disclosures on energy in your trustees report. So I've set those out on the slide. They are the Academy Trust UK energy use and associated greenhouse gas emissions, and these need to relate as a minimum to gas, any purchased electricity and transport fuel. You also have to include an emissions intensity ratio, and for consistency across the sector, you are encouraged to use tonnes of CO2 per pupil so that the comparison can be made across the sector. You also need to include the methodologies that you've used in arriving at your calculations for the disclosures, and also some narrative on the measures that you've taken to improve energy efficiency in the period. If you are a large company and you consume less than the 40,000 kilowatts, then you're exempt, and therefore you only need to include a statement in your trustees report to state this. If you are non-large, then these disclosures don't apply in your accounts. However, if you do consume greater than 40,000 kilowatts, then you will have to make the disclosures on your website by the 31st of March 2021. If your energy consumption is below that threshold, you don't have any requirements. However, the ESFA are still recommending that you consider including this information on your website anyway on a voluntary basis. So if we just turn to the next slide, I just wanted to mention that the ESFA has published separate guidance online on the energy and carbon reporting. So as one of their good practice guides, if this does apply to your Academy Trust, it is worth a look. It does include information on how academies can gather the data using meters, data, invoices or statements from suppliers, and it includes an example on actually how you calculate the figures as I've set out on the screen. And then in the next slide, again, it also includes the associated example disclosures that you would include in your trustees annual report. So definitely worth a look as you prepare your annual report if you do fit into this requirement. Then on my next slide, I was going to move away from the large company reporting and move on to the COVID-19 considerations. So as Kath said, the ESFA do plan to issue an update bulletin to address the impact that the pandemic has had on the Academy trusts, how that's going to impact its financial statements and also audit requirements. As we said, this has yet to be issued, but what I thought I would do on this slide is actually include what we expect the trustees annual report disclosures to be, and this is based on the guidance that's been issued to the charity sector. The SORP committee issued some guidance in March, and this is relevant to Academy trusts because you are charitable companies, and as Kath said right at the outset, the Academy's accounts direction is based on the charity's SORP. So really the suggested disclosures are as you would expect, really. So what impact has the pandemic had on the Academy Trust's main achievements in the year? Has it resulted in any financial uncertainties? What impact might this have on your financial sustainability? And importantly, going concern, and we talked about the going concern assessment and the period of review in an earlier slide. And what steps are you taking to address any issues that might have arisen? Also, any impact on your ability to fundraise, if that's applicable to your trust, and how the pandemic has affected your staff, your pupils, any volunteers working with you, and what implications it might have for the following academic year as well. If there has been any significant impact on your risk profile, any of your risks have been exacerbated by the pandemic, you would set this out in your trustees report. And also importantly on your finances, on your level of reserves, and whether there has been a reconsideration of the reserves policy as a result. So then moving on to my next slide, this is now the governance statement, so the second of those reports. This statement is an additional statement required by the ESFA, so it is in addition to the governance information already included in the trustees report, which we referred to earlier. And the areas that are covered are things like the board members and meeting attendance statistics. This is where you would include your annual review of governance arrangements, subcommittees and meeting attendance statistics for the various subcommittees of the board. Also the accounting officer's review of value for money for the year, and a review of the internal financial controls and the operation of those controls in the period. There are two new requirements for the governance statement which were introduced by the Academy's accounts direction this year. The first is to explain how the audit arrangements have been affected by the revised ethical standard, if this applies. So the change here is that under the revised ethical standard, external auditors of Academy trusts can no longer carry out the internal assurance or internal scrutiny assignments on behalf of the Academy Trust. So if this is the case for your trust, you would need to set this out in your governance statement and what your plans are to address this requirement going forward. And then there is also another addition this year, and that is that if the trustees have actually reviewed and sort of taken account of the DfE's governance handbook and their competency framework on governance, then you are encouraged to state this explicitly in your governance statement in the accounts. On my next slide, really just looking at the accounting officer's statement on regularity, propriety and compliance. So really here, no big significant changes, just two clarification points were introduced by this year's accounts direction. The first clarification is that if there are any instances of irregularity, impropriety or non-compliance that are noted in the year, then these should be stated in the monetary amounts if these are known. And the second one won't apply to all trusts, only if you are your trust is winding down. But it's really a clarification that the requirement to have an accounting officer in place that is able to sign off on the regularity statement actually includes the period up to the run-up of trust closure. And then moving on to my final slide, we have the Auditors Reports. So as I'm sure you're aware, a set of Academy Trust accounts will include 2 audit reports. The first is the Independent External Auditors Report on the financial statements. So this is the true and fair opinion on the financial performance and financial position of the Academy Trust. And the second is the Independent Reporting Accountants Report on Regularity. So really the auditor's conclusion on regularity, which should mirror the disclosures in the accounting officer's statement on regularity, which we just touched on. So again, to mention here that it is likely that both audits will have regard to the impact of the COVID pandemic this year. So in the first instance, the financial statements audit, there'll be a need there to ensure the auditors will need to ensure that there has been appropriate disclosure included in the report and financial statements of the impact of the pandemic on the Academy Trust's activities and its going concern assessment, as we talked about earlier. And then also from the regularity audit perspective, there will be a requirement there for the auditor to consider whether the lockdown measures, the remote working, have had any impact on the Academy Trust's financial procedures and controls, and whether these have been able to continue operating as intended during the period. So really that comes to the end of the narrative sections within an Academy Trust report, and I will hand over now to Hugh and the financial statements section.
Thank you, Catherine. So I'm going to talk through the financial statements and focus on the numbers sections of the accounts. I'll pick up all of the new areas that have come into this year's financial statements. Fortunately, not too many of them, so I'll also pick up a number of reminders about the key information in the accounts, because there are a lot of disclosures needed in a set of Academy accounts. So on my first slide, we talk about the statement of financial activities. So there's 3 primary statements in any set of Academy accounts. There's the statement of financial activities, which reports the income and expenditure of the Academy Trust for the year on an accruals basis. There's the balance sheet, which shows the position as at 31st of August, so the position at a point in time, and the statement of cash flow, so the cash ins and outs during the year. And the key to the statement of financial activities is understanding the columns and the rows. So firstly, with the columns, the Academy Accounts Direction follows the charity statement of recommended practice, as we've heard. So we have this a column-based set of accounts. And the idea here is to distinguish between those funds that are freely available to use for anything within the Academy Trust and those funds that are ring-fenced for particular purposes. So we've got the restricted funds split between the restricted general funds and the restricted fixed asset funds, and then the unrestricted funds as a separate column. So those are the three different columns. You'll see that most of the activity goes through the restricted general fund, and this is because the core funding for academies, so the GAG and local authority money that's used for revenue purposes, is actually ring-fenced. Although it can be used for most things, for example GAG within the Academy Trust, it is technically ring-fenced for the education of the pupils this year. So it shows within the restricted general fund column. So most of the income will show within there, and most of the costs of running the academy will also appear within that restricted general fund column. Interestingly, the local government pension scheme also sits within that fund. So you'll see actually at the bottom of that column, the fund in the Coketown model accounts is in deficit, and that's because you've got all of these local government pension scheme obligations sitting within that fund. The restricted fixed asset fund is kept separate in a set of academy accounts. This is sometimes done in charity accounting, but is something they've sort of mandated within academy accounts. And I think the reason for this is that the key assets of an academy trust, so the buildings in particular, are funded by government. As a result, the academy is not having to sort of build up surpluses in order to sort of fund the replacement of its buildings over time. So what goes through this restricted fixed asset column is that any funding that is funding particularly for fixed assets, so SIF funding, that kind of thing, and the depreciation charges that you incur on those fixed assets. And unless you've received a lot of funding for fixed assets in the year, this column will, the net income or expenditure in this column will often be a deficit. However, that deficit is not necessarily a problem because the assets that are represented in that column are funded by government, so you don't necessarily need to worry about that from an operational perspective. So therefore, when we come down to the net income or expenditure of an academy in the year, we see that Coketown in this case is showing a 54,000 total net income for the year before actuarial gains or losses. But actually, once you add back the depreciation charges and the amounts in the fixed asset fund column, it's making a very healthy surplus in the year. So really, when you're looking at a very quick glance at how an academy is done for the year, you're really looking at those two revenue fund columns, the net income or expenditure on the unrestricted funds and the restricted general funds. That is still slightly distorted from what you see on your management accounts because we have these notional pension scheme charges going through the restricted general fund column. So as well as the actuarial gains or losses that go below the line at the bottom of the statement of financial activities, you also get charges within the expenditure row in the restricted general fund column for the service charge for the local government scheme pension, which is a notional charge rather than a cash charge. So those are the columns in the set of accounts, but the other key issue is what goes on the individual rows, and the income is broken down between four main categories: donations and capital grants, the charitable activities, trading activities, and investments. So investments, that's just interest income if you get any at the moment. The donations and capital grants, donations is could be restricted or unrestricted, but just any donations you receive, plus the capital grant funding for the fixed assets. Charitable activities, that's where the core sort of GAG funding and local authority funding is included. There's also a bit of a grey area, if you like, with school trips and catering income. So these are quite significant in some academies. They're not actually shown separately within the Coketown model account, so the ESFA hasn't mandated where they're included, and it doesn't fit 100% within any category. However, most commonly it's included within the charitable activities row. And the reason for that is because the reason for doing school trips and catering is part of the education. You're not doing it with the intention of trying to generate money. The purpose is because it's ancillary to the education at the school. So therefore it fits most naturally within charitable activities. So the other trading activities row within income, that includes anything you're doing for the purpose of generating income. So the most common thing here is lettings income and things that go through your trading subsidiary. On the expenditure side, there's often much fewer rows on the expenditure side. So you will see many sets of academy accounts with just one row with the Academy Trust's educational operations under charitable activities. But some other academies include expenditure on raising funds. So expenditure on raising funds could be things like if you've got lettings income and you've got someone who does a lot of work on those lettings, you could allocate their costs to expenditure on raising funds. There may be an overhead allocation as well, but often that's not too significant or not too material. And so some academies don't include that, but others will if it's more significant. So that's the sort of expenditure side. You will have in some academy trusts other rows on the statement of financial activities. So if you've got a teaching school, that needs to be separated out in both income and expenditure. And if you've got any academies, either any schools joining the trust or leaving the trust, that will go through all as a separate line on the statement of financial activities. So whenever you've got a school joining or leaving, you typically have a building to bring on into the statement of financial activities or remove, a local government pension scheme liability, and a balance of funds, and we put that all on one row, even though the pension scheme liability is often a negative figure on that row. So those are the key points in the statement of financial activities. I'll just now turn to the next slide on the balance sheet. So this is the basically the financial position as at 31st of August 2020. So it's just taking the position at a point in time. There are two numbers which are really the most important numbers in any set of academy accounts. Unfortunately, neither of those numbers actually tend to appear in most sets of academy accounts. So what are they? The first one is the amount of available reserves that you have at the year end. So the bottom half of that balance sheet gives details of the Academy's reserves, and they follow really the columns that we saw previously on the statement of financial activities. So you've got the fixed asset fund there, which represents all the buildings and everything, and the pension scheme reserve. But the two key figures really are the unrestricted income funds, which in Coketown's accounts this year is 278,000, and the restricted income fund, which is 464 in these accounts. The unrestricted income fund can be spent on anything at the Academy Trust within its objects. The restricted income fund is typically made up of mostly of gag funding and other things that are fairly flexible. You've got to be slightly careful on this because there could be some much more heavily ring-fenced income funds in there, such as, you know, an AstroTurf sinking fund or a something ring-fenced to buy a minibus, that kind of thing. So you've got to be a bit careful with that. But generally, these are funds that can be spent on operations. So so really, it's those two taken together that are your sort of available money at the end of the year. So in this set of Coketown accounts, they've got nearly $750,000 of available funds as at 31st of August 2020. So a healthy balance sheet position. But that number is really crucially important, because obviously if it gets too low, it could indicate that you're running out of money and have got going concern issues. Obviously, if it's a lot higher, then you're in a good position for investing in the future. So that's one really important number to understand in the accounts. The second most important number is the movement from one year to the next in that number. And so that's really your operational surplus or deficit in the year. And so the way to sort of calculate that is those two numbers added together, so the 464 plus the 278, and then you deduct the previous year's numbers, so the 98 and the 155. So if you do that calculation for Coketown, it ends up saying there's a £489,000 surplus on revenue reserves in the year. So Coketown's made a really healthy surplus in this set of model accounts. That's a really important factor for the Academy, because it's that's a significant surplus. But obviously, if it's a deficit or something, that's what you need to one of the key things you need to understand about the set of accounts. And the other important thing with these numbers is that they should relate to your management information. So a lot of the information within a set of statutory accounts doesn't relate well to what's in your management accounts, because you don't have things like the local government pension scheme figures in there, because that's a year-end adjustment that goes in the statutory financial statements. However, that movement on your revenue reserves, that unrestricted income fund and the restricted income fund, those balances and the movement on the year in that should relate to the surpluses or deficits you're tracking in your management accounts and the balances you're reporting in your management accounts going forward. So very important numbers. Otherwise, the balance sheet's more sort of straightforward and standard. So at the top, you've got your tangible fixed assets being the biggest number usually on the balance sheet, being mostly your buildings. You may have some software or something which is an intangible assets. Not all academies have material intangible assets to include on the balance sheet. Similarly with stock, it's not always material for Academy Trust, so we don't always see that on the balance sheet. But debtors, creditors and cash we always see. Debtors is your sort of VAT receivable, your prepayment, payments. In virtually all Academy accounts, there's 2 months of pupil premium income to accrue, so that's all included in debtors. In creditors, you have your trade creditors, your accruals, those kind of liabilities. Also on the balance sheet, you've got your defined benefit pension scheme liability. So that comes from your local government pension scheme actuarial reports, the numbers in there. As I say, this is your obligations in the future to pay out pensions for the support staff who are members of the local government pension scheme. So it's a sort of long-term theoretical liability rather than an immediate cash liability. There have been triennial valuations this year for the local government pension scheme, so that will probably influence some of the information in this year's accounts when the actuary comes to preparing it, but ultimately that it's the same figures from the actuary that you're relying on to include in these financial statements. And one of the main operational implications of the triennial valuation is that many of you might have had change of rates of contributions, so cash contributions into the scheme from April this year. So those are the key items to highlight on the balance sheet. My next slide picks up the accounting policies. These are fairly standard in the Academy accounts, so I won't spend a long time on this. So most of your accounting policies will look exactly the same as the Coketown model accounts. One new thing or thing they've clarified this year is around subsidiaries and consolidation. So if you've got a trading subsidiary, it would be normal to then prepare a set of consolidated financial statements. However, there is an exemption if it's not material to the overall financial statements to then not prepare. You have the option not to prepare consolidated financial statements. The accounts direction this year has clarified that if you have 2 or more subsidiaries, which isn't that common, and you're considering whether to prepare consolidated financial statements, you have to take the subsidiaries combined figures to consider if they're material. You have to include accounting policies in all material items in the financial statements, and one area to flag up would be that you need a policy on critical accounting estimates and areas of judgment. For most academies, this just means it's fairly standard wording that depreciation and local government pension scheme valuations are done on the basis of estimates. However, it is worth noting this if you have got other key judgments or estimates in the account. So, for example, a significant provision in the accounts, you may need to provide additional information within the accounting policies section. Going concern is often a standard statement on going concern, but obviously if there are any uncertainties around the financial viability, that's going to be a key section, so the wording needs to be framed very carefully there if that's the case. Over to the next slide, we start picking up on the notes to the financial statements. I've covered the key things I wanted to say on a lot of the income and expenditure notes when we talk through the statement of financial activities. They just sort of break down the detail of those items. But just other points to note. If you're on one of the old funding agreements, and so these are sort of funding agreements dating back probably over 10 years that haven't been changed, you may have this limits on how much funding you can carry forward, how much GAG you can carry forward. So there used to be years ago a 12% limit for how much academies could carry forward of GAG. So if you are on one of those old agreements, you may still be subject to that, and there's a disclosure that needs to go in the accounts to say whether you breach that limit, and if you do breach it, there's potential clawback, so it's an important one there. A new item within the cost notes this year is the disclosure of legal costs. You may be able to see that on the slide there. It's sort of separated out in the expenditure note. They actually have 2 categories: legal costs on conversion and other legal costs, I suppose because legal costs on conversion tend to be more significant. So these need to be separately disclosed this year. It should be fairly straightforward. I mean, I'd take as a starting point any costs you pay to lawyers just being the legal costs. There is potential grey area for debate around this. I mean, often some of the services lawyers provide these days could also be provided by other outfits, so don't necessarily need to classify legal costs. But generally, as a guide, I think the starting point should just be the amount you pay to the lawyers and those legal costs. The other disclosures, just to highlight, these aren't new, but they're easy to forget, so just worthwhile reminding, is there's certain items, if they're over £5,000, that you have to provide separate disclosure in the financial statements. So these are compensation payments, gifts made by the Academy Trust, or any losses on fixed assets, stock or bad debt, so things that you write off in the financial statement. So if you do have any of those, you'll need to note them in the notes to the accounts. It's also worth noting that under the fixed asset note on the balance sheet side, if you have any acquisitions or disposals of land and buildings, that needs to be disclosed. It says over £5,000, but they will be if they're land and buildings. That needs to be disclosed separately in that note, and that's really only if you're acquiring a new lease or freehold or disposing of one that becomes important. Just to note also that, as Catherine said, there's COVID guidance due to come out, so we can't fully comment on that yet because it hasn't been released, but what we are fully expecting is additional information in the notes to the financial statements this year, giving details of any furlough or any government grants relating to COVID and any exceptional costs as well. So it is worth sort of looking out for that when that comes out, because we're expecting we'll probably get some new information that we need to disclose in the financial statements, which isn't covered in the accounts direction. So over to the next slide is picking up on staff costs. The staff cost disclosures haven't changed this year, so it's the same as we've had previously. However, they're often the most sensitive disclosures, so it's worth just spending a moment on these. So the breakdown of staff costs is as usual, split down between wages and salaries, social security and pension. You also have to separate agency costs within this note, as well as any staff restructuring costs. Staff restructuring costs have even more breakdown within the note, and in particular what they're looking to separately disclose is any non-statutory or non-contractual staff severance payments. So what this means is that is really compromise agreements, things that come through negotiation. So when people leave the Academy Trust, there's going to be a statutory amount to pay, or potentially something under their contract they're entitled to be paid. So that doesn't get included here. It's only the extra amount, if there's been some sort of a compromise that you've paid beyond that, needs to be disclosed. And you actually have to disclose the individual amounts, although you don't have to name the individuals. As well as that, you need to disclose the average staff numbers. So this is really on a headcount basis. So it's just really taking the number of people on payroll for each month and then dividing it by 12 to come up with the average staff numbers. Just to note that in the accounts return, you have to do it on a full-time equivalent basis. That's if someone works 3 days a week, you cast them as 0.6. So that's a different basis. So if you're preparing the information, maybe worth doing it at the same time. But for the statutory accounts, it's on an average headcount basis. You also have to give details of people earning over £60,000. So this is their sort of earnings. So it doesn't include employers' NI and doesn't include employers' pension. So anyone over £60,000, you've got to give details of the numbers of people in bands of £10,000. So how many people in each band of £10,000. You've also got to give details of the total remuneration of key management personnel. So this will be the senior leadership teams, and normally sort of say 3 to 5 people you've identified as key management personnel. And you don't have to sort of split it down by person. It's just the aggregate total remuneration of those key management personnel. Different to the higher paid bandings, this does include employers' NI and employers' pension in this disclosure. In addition, you've got to disclose any remuneration of trustees. So typically the accounting officer will be employed as an employee as well as being a trustee, and therefore their remuneration, as well as any other paid trustees, needs to be disclosed in the notes to the accounts. And you need to disclose their earnings in a band of £5,000, as well as their pension, again in a band of £5,000, and then there you do name the individuals. So over to my next slide, picking up on related party transactions. So this is a really important area, both for Academy Trusts in particular, but it's actually heavily included in the accounting and auditing standards as well, because it's more generally an area of risk for financial statements. So what this relates to is organisations and individuals who are connected to either trustees or the key management personnel. So if the Academy Trust is transacting with either organisations or individuals that are connected with the trustees or the key management personnel, you've got to have disclosures in the accounts relating to that, and there's no de minimis limits around that. A lot of information's got to be disclosed, and they've got example disclosures in Coketown, but you've got to disclose the nature of a relationship, the description of the services, the value of the transactions, any amounts owing at the balance sheet date. There is also this at cost requirement for any goods and services provided by a related party. So if it's over £2,500, it's got to be at cost, which means there's no markup in the goods and services that are provided. And the Academy's got to obtain a statement of assurance that the goods and services are provided at cost, as well as having it on an open book policy, so the Academy Trust can check that if it wants. So you've got to disclose that that's confirmed within the disclosure in the accounts, as well as the fact that you've complied with the requirements of the Academy's financial handbook. And those requirements include this requirement to get approval of any related party transactions over £20,000 before entering into the transaction, and you have to get retrospective approval if it's below that amount. The example disclosures include both transactions with organisations, as well as an example of one with an individual, so a family member of one of the trustees. In the Coketown case is the example. So in order to capture this information, Academy Trust will normally request that the key management personnel and trustees complete declaration of interests, so that the Academy and their auditors are aware of any individuals or organisations that the trustees and senior management are connected with. And on my next slide, just picking up on some other disclosures, multi-academy trusts have particular disclosures relating to them. So firstly, there's details of expenditure by school. That's sort of quite a high level, so just picking up staff costs, other costs, depreciation, that kind of thing, at a school by school level. Multi-academy trusts have to include details of the revenue reserves by school, so just split down the reserves by school. It may be a situation that the overall reserves of the trusts are in are positive, but there are some individual schools that are in deficit. So if that's the case, any individual schools that are in deficit need to be explained within the notes to the financial statements. As well as that, the multi-academy trusts have to disclose central service charges, or top slice, however you want to call it. So charges to individual schools from the centre, that needs to be disclosed by school and added up to a total within the notes to the financial statements. And you have to describe what that related to. So normally it's to cover the costs of things like HR, finance, IT, premises at the centre. On the reserves disclosure, there isn't something new this year, and what it says is that if the reserves of individual schools are zero, you don't then need to disclose the individual school balances. You just have to make a disclosure note below the table to record that. And I think what this is responding to really is the fact that a lot of multi-academy trusts are moving to pooled reserves policies now. So this is sort of recognising the fact that, I don't know, a lot of the thinking with MATs is that everything's more as a combined trust rather than looking at things on an individual school basis. So reserves are pooled at the centre and then sort of allocated on the basis of need. This is different from GAG pooling. So GAG pooling is where you're pooling the money going in at GAG before you start the year. Reserves pooling is that each academy might have their own individual GAG funds and utilise that during the year, but it's the money left over at the end of the year, pooling that together for utilisation across the trust. So if you've formally within your reserves policy and internally within the trust gone and pooled the reserves, this may influence how that's presented in the notes to the financial statements. And academy trusts have been doing this previously, but there's not been proper recognition of it until now within the accounts direction. Another new note this year is the net changes in debt disclosure, which is there on the slide. it includes quite a bit of information there, but actually a lot of this won't be relevant for a lot of academy trusts. So what this is trying to capture is not just the cash that you're holding as an academy trust, but also any debt, so any finance leases and loans, maybe an ESFA loan or a Salix loan in there, and show the change in the brought forward to carry forward net debt position. This will be a shorter note for most academy trusts, because a lot of academy trusts don't have any debt, maybe the odd Salix loan, and certainly finance leases are generally prohibited without permission within the financial handbook. So not many academy trusts have finance leases. So often there's not many rows to this, and the columns, a lot of those will not be applicable, things like acquisition and disposal of subsidiaries. So it's probably quite a short note for most academy trusts accounts, and also it's essentially mechanical, and it's nothing that you need to prepare lots of extra information to produce. It just comes from the other information on your trial balance and in the accounts. And finally, the teacher's pension disclosure. The disclosure has been updated in this year's Coketown accounts to reflect the latest valuation of the whole of the teachers' pension scheme in the country. So it includes details of the overall valuation and updated disclosures there. Actually, the valuation happened in 2019, so this probably went in all of your accounts last year. It's just that the Coketown and the timing of its release meant that it wasn't in the Coketown accounts last year, and so that's been updated this year. But now that's all in sort of template disclosures and captured in the financial statements. So that's everything from me on the financial statements. Really, there's a few key numbers that you need to be aware of in terms of surpluses and deficits and reserves carried forward, but there's a huge amount of detail in the notes to the financial statements, which is required for Academy Trust accounts. So it is worth investing time understanding the detail of that and where the information is going to come from for the year end. But now I'll hand back to Kath to cover questions.
Okay, thanks, Hugh. We have a little bit of time to cover some questions. The first looks at the Trustees report, so maybe Catherine, something that you could answer. So given that there is no external data this year in terms of academic results, what are we expecting in terms of the disclosures relating to achievements and outcomes within the 2020 accounts? Maybe Catherine, you could respond to that.
Thank you, Kath, and a really good question, actually, and not something that has been picked up by the accounts direction. I guess the first thing to note is that all Academy Trusts will obviously be in the same boat in terms of, not having that external data available. But really, I don't think this means that there's nothing to say at all in that section. If we go back to what the requirements are around, your achievements and performance, is really setting out on how the, Academy has delivered against its aims and objectives, and using things such as, examination data, Ofsted inspections as benchmarks is one such way of doing that, but by no means the only way. So I think, reference to internal benchmarks, setting out pupil achievements that are monitored internally, pupil attendance, recruitment levels into the next year, also the financial performance. I think they will probably, particularly with the additional disclosures around the impact that COVID has had during, that final term, there will probably be quite a lot to include in this section in any case, I would suggest.
Great, thank you. We've had a question in relation to further training on the statement of financial activities and balance sheet. We have got a part 2 to the webinar that's being held next Thursday, the 16th of July, which will cover some of the more practical steps in pulling the accounts together, particularly in terms of the sort of the working papers and workbooks. So that might be a useful webinar to attend just to cover some of that. But happy to pick that up offline as well if that would be useful. Just one more question relating to the Trustees report. So in terms of individual schools where you have a multi-academy trust, really just the expectations there in terms of how much information you would give relating to individual schools for a multi-academy trust within the Trustees report. So again, Catherine, maybe just to pass to you.
Thank you. So again, an interesting question. I guess it really does sort of depend also on the scale of the Academy Trust. In some of the early days, I think some trusts did go through sort of details on an individual school basis. I think that probably, if you wish to do so for a small trust, and that's the best way that you report against your individual aims and objectives, I think that is appropriate. However, it probably is worth looking at those achievements as a whole. So really, as part of the MAT's strategy, they will probably have an overall strategy for the MAT in terms of its performance and achievements around the various constituent schools, and therefore the reporting would probably follow that same format. So definitely picking up individual achievements at schools, but probably not on a sort of individual case by case throughout the report, I would suggest.
Great, thank you. We also probably time for just one more question. In terms of staffing costs, a question here. So we have many support staff on the local authority pay spine, but they've not yet been issued the pay award and are unlikely to receive this before the year end. When they do, it will be backdated to April 2020. So just looking at how that would be accounted for. Hugh, I don't know whether you've had a chance to look at the questions or not, but just throwing this to you, I wonder whether you'd be able to answer that one.
Thank you. So this really relates to, will this relate to our year? So it's a backdated pay award. So if it gets awarded after the balance sheet date, does it sort of adjust the figures in this year's accounts and go back into our year? When you're looking at this, it all depends on sort of the conditions that exist at the balance sheet date. And I think for these sort of local authority pay spines, if you're effectively obliged to award the pay award regardless as a result of contractual obligations, and it's just confirming the exact amounts post year end, there could well be an argument for accruing this in the accounts, but it depends on the sort of whether it's something that you have a decision over post year end, because in theory, if you could decide not to make the pay award and decide against it, you haven't had the obligation at the balance sheet date. It was a post balance sheet decision to give that pay award. But if you feel like there is an actual obligation there, you just haven't quite confirmed the amount, the exact amount at the year end, that could be something that ends up being adjusted in the accounts.
Great, thank you. And then probably just chance to squeeze in one more. Just in terms of a member of the senior leadership team on maternity leave for the full reporting year, what does that mean in terms of some of the disclosures within the staffing costs note in terms of senior staff salaries? Hugh, I don't know whether you wanted to pick that one up.
Yeah, so if they're on maternity leave, then I suppose you've got to consider your key management personnel note. So you think about whether there was any cover for that maternity leave and whether the person covering the maternity leave would be considered part of key management personnel in their role during that period, and therefore include their remuneration in that calculation or not. So I think you potentially got both the cost of maternity leave, and you could have the cost of the other person coming in during that period, but it's just to assess whether you're just operating with one person down or not. In terms of the higher paid disclosures, if this is a higher paid person, normally it's just on an actual basis. You don't sort of try and sort of reannualize or something to cover the maternity leave period. So it could well be this person drops out of the higher paid disclosures during the year that they're in which they're on maternity leave.
Great, thanks very much. So I think really we'll wrap up there for today. Many thanks to everyone for attending. We will, if we've missed any of the questions that have come through, we will follow those up afterwards. And as I said, the recording and the slides will be made available after today's webinar. The second part, for which an invite will be sent out shortly, will be held next Thursday, the 16th of July at 10 AM. And that's really looking at the more practical steps required for pulling the accounts together and also preparing for an audit, and a little bit of guidance in terms of what is undertaken as part of that audit exercise. So many thanks again, and we'll wrap up there. Thank you.